Equity or debt? Which is a better investment choice? Should you focus on growth or stability? If you ever wondered about the difference between these two investment avenues, this video will help you to understand them clearly. I'm Dr. Bharathi Sunil. Welcome to our Finance and Accounting Academy channel. Equity and debt are two of the most important sources of finance and investment options. But how do they differ? One offers ownership and growth potential, while the other provides fixed returns and greater stability. Let's understand the pros and cons of equity and debt, and also the key differences between equity and debt in a simple way. What is equity? The primary source of finance to any company is equity share capital. So when you purchase shares in any company, it means you are taking partial ownership in that particular business, and whatever the profits the business is doing, you will get that profits in the form of dividends. Debt. What is debt? The use of debts as a source of long-term funds has been quite common and widespread among companies. So companies use these debts to borrow money from investors. So investors lend their money to company with a promise of repayment of that money and interest. The debt instruments are tailor-made to suit the requirements of the borrowing company as well as investors. Now we'll see the features of equity and debt. If you see ownership, equity shareholders are the owners of the company, but holders of debt instruments are not the owners of the company. They only lend money to companies. Risk level. If you take equity shares, you have to bear higher risk because equity shares are depending upon the market situations. But in case of debt, the risk level is low because the rate of interest and also the maturity period is fixed before issuing debt instruments. Next, coming to return. Here you can expect 12 to 15% or more than that also if the market is favorable in case of equity. But if you see debts, generally the percentage of interest will be from 7 to 9%. And in case of equity, the return type is variable because you can't expect the same returns every time. Sometimes you may get higher or lower, or sometimes you won't get also if the situation is not favorable to the investor. Suppose if the market situation is not favorable to the investor, then he won't get any return. If you see debts, return is fixed. And in case of equity, there is no guarantee of our returns. But in case of debts, there is guarantee because the interest rate is fixed prior to issuing debentures. Next, voting rights. In case of equity shares, the equity shareholders indicate their approval or their disapproval of the managerial actions by using voting rights. In case of debts, investors won't have any voting rights. Next, investment volatility. If you see volatility, then it is very high in equity, and in case of debts, it is very low. Next, priority in bankruptcy. If the company gets wind up because of any reasons, then equity shareholders will get their claim in last. That is called what? Residual claim. But in case of debenture holders, they will have first right. So, is it clear? In case of equity shareholders, they are having residual claim on assets. Means the claims of the equity shareholders on the assets of the company are secondary to the creditors and are relevant only when the firm is being liquidated. Next, we'll see pros and cons of equity and debt. If you see equity, what are the advantages? In equity, you will get higher returns and your capital can also be appreciated. And next, whatever the company income is there, that will be provided in the form of dividends to the equity shareholders. Next, equity shareholders are having voting rights. And what are the disadvantages of equity shares? They're having high risk and their returns are also not guaranteed, and they have to face market volatility. If you come to debts, The advantages are debts are very safe and secure, and they will get fixed income, and they also know what are their predictable returns because the returns are specified before offering debentures. In case of debts, the risk is low. And debts are also having some disadvantages. What are the disadvantages when compared to equity? They'll get lower returns, and they have to face inflation risk also, and they don't have any ownership rights in the business. So what you have understood here, equity means ownership. When you take equity, you will become part owner of the company. In case of debt lending, you will lend money to someone, like you're lending to whom? You are lending to companies. And equity, high risk, high return. In case of debts, low risk and fixed return. Here that fixed return is also low, but they are having guaranteed returns. And balance according to age means if you are young, go for more equity. If you are old, go for more debt, because in case of equity there is lot of risk. So if you are young, go for equity, and if you are old, it's better to have safe investment, so go for debts. You can see the smart investing tip here. Young investors should go for more equity, and the conservative investors should go for more debt. And if you want to have balanced portfolio, then you mix both of these financial instruments. So to conclude, equity and debt each have their own advantages and risks. Equity can offer higher returns with higher risk, while debt provides more predictable returns with relatively lower risk. The right choice depends on your financial goals and risk tolerance. So keep learning and invest wisely. Follow Finance and Accounting Academy channel for more finance and investment concepts. Thank you.